Hello everyone. A lot of investors and a lot of big names in the investing space are worried about inflation, and with a good reason. Inflation can eat up a lot of your saving and it can hurt your portfolio dramatically if you're not positioned well. So in this video, we are gonna dive into what are the strategies to protect your portfolio against inflation and even how to profit from it. So we will touch upon what is the historical perspective of inflation. Then we are going to look at commodity and asset price inflation and what is happening right now. We will then take a look at the purchasing power of money, and then we will move to the backbone of the video, which is which strategies do we have as investors to not only protect ourselves from inflation, but even how to profit from it. Before we start, I must say that I'm not a financial advisor and this video is not financial advice. Please do your own due diligence before investing in anything. If we start from the very basic to see what inflation actually is, the definition of it is that it's a measure of the general increase in prices and the fall in the purchasing power of money, which essentially are two sides of the same story. So in this video, we will look at both aspects, how goods are becoming more expensive and how money are losing value. If we look at inflation from a historical perspective, we can see that in the last century there has been big ups and downs with inflation. At the beginning of the 1900s there was a huge spike in inflation, and then it came down in the Great Depression, with quite a few years of deflation actually, for then spiking up again during and subsequently to World War II. Then down again for a couple of decades, and then up during the 70s and early 80s. For then coming down once again, meaning that in the past 40 years we really haven't had any high inflation. So the inflation has really generally been below 5 to 4% mark. So what we can get out of this chart is that in the historical perspective, high inflation has come up 3 times in the last century at an approximately 20 to 30 years interval in a very cyclical manner. So a lot of people are then starting wondering, since we haven't had really any high inflation in the last 40 years, are we perhaps due to such an economic trend? My perspective is that I have no clue and I cannot time the market. However, I know that sooner or later high inflation will come back. It's just a matter of time. So I want to be prepared when that happens so that my portfolio and my savings will not be hurt by it and perhaps will even profit from it. And the reason why people are right now freaking out with inflation is because, as we can see, the Consumer Price Index, CPI, which is a weighted average price of things in our life, has just passed the 4% mark in April. So the big question now is this just a temporary spike or are we actually getting into a trend of high inflation? And why has the consumer price index spiked recently? Well, that's because in 2020 a lot of raw materials have increased substantially in price, all the way to silver, which grew almost 50%, along with other commodities which grew double digits, for instance, natural gas, copper, corn, wheat, and so on and so forth. Outliers have been coal and oil, which actually decreased in price in 2020. But in general, what we can get out of this table is that a lot of raw materials have actually increased in price in the last year. So it makes sense that the price of goods increased and therefore inflation is picking up. The most dramatic example has been lumber, which for 50 years has been trading in the 200 to 400 range, but last year had a spike in price to 1,300, which is pretty insane. Real estate is also steadily growing, and what happened in 2008 now starts to look like a bump in the road for the long-term uptrend. To give you an example, in the city where I live, which is Copenhagen, it has also seen a quite significant increase in real estate prices. Such an average apartment, 2 bedrooms, located in the average neighborhood, average building, cost about 2 million Danish crowns back in 2014, and now it's approximately 3.3 millions, which if we translate it in US dollar would be an increase from 330,000 to 540,000. So in 7 years, essentially, this which we can call an average apartment, increased more than 50% in price, which is an annual compounded growth of about 7%. 7% is much higher than the average inflation rate of the last 40 years that we have seen to be below 5-4%. So what we've seen here is that raw material prices are increasing at double-digit rates in the last year. Houses are increasing at price higher than 4% mark in the last few years, and the CPI has just breached the 4% mark in April this year. So we are all seeing indication that the price of things around us are increasing, and perhaps are increasing even at an accelerated pace. Along with that, money is able to buy less and less every year. And if you look at this graph, it's astonishing how the purchasing power of the dollar decreased 26 times from the beginning of the 1900s to now. And there are several reasons for it. A very important one is the money supply. Central banks are printing money out of thin air like crazy. Just to give you an idea, in the last 12 months, the US Central Bank has printed a fifth of the dollars that have ever existed and inject them in the economy. So today there is 20% more dollars around than there were 12 months ago. It's insane. And basic economics tell us that when a resource is less scarce, like in this case money, it's also becoming less valuable. Another piece of the puzzle is the federal funds rate, which explained in a very simplistic way is the cost of borrowing money. This is a lever that the Federal Reserve has which stimulates the economy when rates fall and cools off the economy when rates increase. As you can see, for the past many years, rates have been close to zero. And that's one of the reasons the economy has been doing so well. And for example, house mortgages have such a low interest rate. However, let me ask you this question. If something, in this case money, costs basically nothing to borrow, and as we have seen in the previous graph, is created out of thin air in massive amount, what is the value of it? I think the answer is that money is worth less and less. And that is the reason one of the big investors of our time, Ray Dalio, came out saying that cash is trash last year. So overall, money being devalued and having less purchasing power, combined with the price of things around us going up, is actually the definition of inflation and is actually what is happening now. So let's now move into what we can do to protect ourselves and our portfolio and potentially profit from it. In order to protect ourselves and even profit from inflation, we need to surround ourselves with hard assets. And the characteristic for good inflation hedge is that it should be scarce in supply, it should be something that is accepted as being valuable. And if we look at businesses, they need to have pricing power. So if they sell a good, they need to have the possibility to increase the price, as all the other goods in the economy will increase in price due to inflation. Based on these requirements, we will talk about different options: real estate, gold, other commodities, stocks, and finally my favorite and most controversial inflation hedge, which is fixed rate debt. On purpose, I left out TIPS, which is Treasury Inflation Protected Securities, because I think they are a terrible idea and investment. So let's leave those off and focus on the others. Let's start with real estate. And real estate is scarce because the land is finite. This is a satellite picture of the city I live in, which is Copenhagen, Denmark. And you can see that it's pretty much already built all over. Sure, there are some fields at the very periphery of the city which will be turned into houses eventually, but this is more or less that. So you cannot really increase the supply of homes so much. Sure, you can build an extra floor if the regulation allow it, but this is it. So if you are buying a real estate in a place that is popular, then you are holding something that is valuable and it's in limited supply. So if you think of real estate in an inflationary perspective, We have a few positive drivers. We have a limited supply. We have the fact that a lot of raw materials are needed to build a new home. So if due to inflation the price of those materials increase, also the price of the real estate will increase, which in turn would benefit the house you own. Moreover, if you are owning a real estate properties, you are probably looking to rent it out and you have a price power on the rent, meaning that if all prices increase due to inflation, you have the possibility to increase your rent as well and therefore keep up with that inflation. One thing worth mentioning is that in order to be exposed to real estate, besides buying a home, you can buy REITs, which is a real estate investment trust on the stock market, and that will expose you to real estate market. Another important thing worth mentioning though, and I'm not going to go into details, is that when inflation picks up, usually what central banks do is that they would increase the interest rate. And if that happens, one could expect the value of the real estate to drop in the short term. So that would be a counter argument and a risk of investing in real estate during inflationary period that you need to wait and take into account yourself. Another hedge is gold, which is one of the oldest form of currency and store of value. If we look at the correlation between gold price and the US dollar index, which represent the strength of the dollar, we can see that for long periods of time, gold and dollar were actually inversely correlated. You can see that here and here and here, and also in the most recent years, for a very long periods of time, gold and dollar actually moved in different directions. That's not always true, and for example here we had a long period of time where the two moved in the same direction. So I don't really like to think of gold as being inversely correlated to the dollar. However, I do recognize that there is quite a lack of positive correlation between the two for long periods of time. And this is a great story and use case for gold, because putting part of the saving in gold would allow to hedge against money being devalued in the long term. I made here a quick calculation that there is approximately 3,000 tons of gold mined each year. And as far as we know, there are about 200,000 tons of gold that have been mined through history, which leads to approximately 1.5% yearly inflation for gold, which is pretty low. This is an additional argument that gold would preserve its value over the years pretty well. Let's now move to commodities, and commodities is essentially all the raw materials we use in our daily life. Commodity prices have a strong link to inflation. In fact, inflation is the price of goods going up. So investing in commodities would allow us to benefit from an increase in price in these materials. In this view, we would benefit both from the commodity price going up due to inflation, but also if we invested in businesses which benefit from an increase in price of the commodities. And these are, for example, miners, which are leveraged on the price of the material they mine. And for an example of this, have a look at my video on cobalt. Then, companies that deal with agricultural products and farmland, as well as oil and gas companies. There are many other opportunities, but essentially any business that produces a raw material for which the price has been increased by inflation will profit. Furthermore, any business that can pass over to the customer the rising prices will do good. For example, pharmacies, supermarkets, etc. And think, if the price of toothpaste goes up by 30% tomorrow, will you stop buying toothpaste? Probably not. Or if you need to buy a medicine and the medicine has just been inflated in price, would you do without it? Probably not. So there are certain businesses that have a pricing power because you need them no matter what. And stocks of those businesses will probably do good in inflationary environments. Businesses that do not do good instead are companies that pay high dividends without pricing power, and that is because their dividends will become worth less and less in real terms as inflation ramps up. Also, companies with very low margins are at risk because they have less of a liberty of increasing prices. And if a company is relying heavily on a commodity to operate, then it's even worse. And that is the case of airlines that are very reliant on oil prices and have extremely thin margins. Finally, my favorite way to hedge against inflation, which is fixed rate debt. And that is because when you set up a mortgage on a house at a very low fixed rate, you are going to pay the same amount of money each month for 30 years or whatever the mortgage is due. However, as inflation eats up the value of those money, although you are paying the same nominal amount each month, you are actually paying back less and less value as time progresses. So this allows you to buy a house while paying back less value than what it's worth. And not only you are going to pay back less value than you should have, but with the debt you can leverage buying a home and potentially having a rental income. So I think that fixed low rate mortgage debt can be a powerful tool during inflationary periods. So I put in this table what we have talked about. What are the drivers and the risks for each of the inflation hedges we discussed? Each of these strategies might fit better or worse in the portfolio, dependently on many factors. So you have to decide for yourself which hedge strategy might work better for you. And always keep in mind that all the things work good on paper and in theory, but unexpected things can always happen. So do your own due diligence before investing in any of these instruments. What I have outlined here is just my perspective of the assets I like and I like to be exposed to in inflationary times. But as I mentioned in the disclaimer, I'm not a financial advisor, so please do your own due diligence. In conclusion, inflation is not to be feared, and actually, if you are prepared for it, and if your portfolio is prepared for it, it's just another opportunity. There are several ways to hedge against inflation, as we have seen, and you have to decide for yourself which strategy you want to go with. That's it for today. Thank you for listening, and I hope you got a lot of value out of this video. If you did, please click the like button and subscribe for new videos. Have a great day.